Okay, and welcome back, students taking math for business and finance and math applications. In the last video, we're doing chapter 17, depreciation, and this is part of the theory videos. In this particular video, either one or two videos, depending upon how long it takes, we're going to cover the method for straight line depreciation. In the last video, I covered an overview of what these theory videos are going to be like, or the topics, the concepts covered. And I also tried to cover the concept of terminology. But I didn't say, my warning that if you don't understand something, go back and rewatch the video. And then if a couple of times, and if you still don't understand how to, what I'm talking about, telephone or contact an instructor to be able to help you understand. The reason why I didn't say that was because most of that stuff we're going to be covering in this video and then the future videos. So, if you don't understand something, yeah, definitely rewind, rewatch, and if you still having problems, telephone or contact an instructor, and they'll help you understand the concepts. So we're going to work on straight line next. This is the first method of depreciation, and it's really the easiest. Okay, and when you create depreciation, generally we create what's called a schedule of depreciation. And for each of these methods, what I'm going, I only have 4 more slides because I'm looking at 4 methods. And on each slide will be a schedule for that particular method, okay? But depreciation schedules all look very, very similar. The issue is depending upon which method you use determines the calculations that you're going to do. And that's what I said, in the beginning of the overview, that this is relatively easy. There's only 4 concepts, but it is math intensive where you have to, you're doing a lot of math, okay? So what's the concept for straight line depreciation? How is that, how do we, go about calculating that? Well, for straight line depreciation, what we want to do is we want to take our cost, and we want to subtract out our salvage value. And by the way, salvage value is synonymous with the term residual value. And I didn't put that in the terminology video. In the last video, I didn't put it on the slide. But it just occurred to me that, I could be talking about residual value, which is the same as the salvage value, okay? So we have cost less our salvage value, and that is all over the estimated useful life in years. Okay, so remember what our cost was? Well, that was the purchase price. Okay, and we kind of like said to ourselves, well, at the end, how many years are we going to depreciate something? Well, in the last video, and like I was showing you, and I actually went into a lot of the numbers in order to be able to explain the terminology. Well, if I had a purchase price of $40,000 and I said to myself, well, I want to depreciate it over the course of 4 years, that's my estimated useful life. And the reason why it's estimated is because I could have went and said, oh, I want 3 years, or maybe I want 5 years. Okay, so I have to determine what my estimated useful life is, but then the next thing that I need to do is to say, okay, well, at the end of that useful life, what do I want it to have as a salvage value? Okay, and in the previous video, I had said, well, for a salvage value, I want it to have 0. Okay, or I wanted it to have 8,000. Okay, there is no set amount. You have to, you determine what that amount is. Now, of course, when you're working these problems, it's going to tell you what those amounts are, okay? But if I'm an accountant, I'm the one who has to be deciding what those amounts are. So we take our purchase price less our salvage value, okay, and that gives me a value of, in this case here, 32,000, right? And I take the 32,000 and I divide it by however however long I estimated my useful life to be. So let's say I estimated it to be 4 years. Okay, so that would means that each year I'm going to depreciate $8,000. Okay, that's the basic math to straight line depreciation. Cost less salvage value over the life. So let me erase all of this. And I'll just quickly rewrite it here. Cost minus salvage value over life, useful life, or just life. All right. Now, when you know that, okay, you sit there and you make these determinations, and then you have to put it in a schedule. Okay. And the reason why you put it in the schedule is so that anyone can see at any point in time what the information that's generated from that. Right? So in the case of the textbook, I don't remember what. Let me just take a quick look at it and see if I can spot. We're talking about equipment. Okay, so we're talking about equipment in the textbook, and they originally said that when they bought the equipment, the purchase price was $2,500. That's my cost, right? Okay, so my cost here is $2,500. And they determined that they were going to depreciate it over 5 years. Okay, so my useful life was going to be 5 years. And they also determined that at the end of those 5 years, it's going to have a salvage value of $500. Okay, now what they're doing with the schedule here is they're just filling in information, okay? Because they were able to, when I take my $2,500 less my $500 of salvage value based upon the formula here, right? I'm going to end up depreciating that equipment 2,000 out of its $2,500. And when I depreciate it, the $2,000 over the course of 5 years, I divide 2,000 by 5 and I get $400 per year. Okay? So, I need to put this information in a schedule. So, in the first column, it has the number, each year. Okay. Then it has the depreciation cost of the equipment. Well, it always stays $2,500 because that's what you purchased it for. And we calculated that depreciation amount was going to be $400. Okay. So that's why all of these figures stay the same. But when we look at our accumulated depreciation, remember, accumulated is how much you've done up to that moment in time. Okay, so in year one, we have a cost of $2,500, and we say we're going to depreciate it $400. So at the end of the year, in the beginning of the year, we had 0 for accumulated depreciation. And we're going to add the $400 to it, and that makes our accumulated depreciation $400. Okay. Now, our book value is nothing more than our cost less our accumulated depreciation, and that's why they're showing that formula there, 2,500 minus 400, which means our book value is 2,100. Now, when you actually create a schedule, you wouldn't be showing that math. Okay, it's already assumed that the people looking at the schedule know the math, but the reason why that math is on the schedule is, for illustration purposes only. Okay, so for the first year, we filled out the information on the schedule. All right. Now for year number 2, again, our cost stays the same at 2,500, and our depreciation is going to be 400, so that stays the same. However, now our accumulated depreciation is the 400 from the year before plus the 400, which gives me the 800. Okay, and then for our book value, all we're doing is we're taking our cost here of 2,500 and we're subtracting out this 800, which gives us our $1,700, right? And it's just that simple. We just keep on going down the line, all right? Year after year after year, okay? So by the time we get down to year 5 here, right, we start out with our $2,500 as our cost, and we know our depreciation amount is 400. To get our accumulated depreciation, we're taking the depreciation from the previous year, the end of the previous year of 1,600, and we're adding in the 400 for depreciation, which gives us accumulated of 2,000. And of course, we take our cost less that accumulated, and that gives me my book value. And at the end of year 5, we had already determined that we wanted a book value of $500, meaning we want to show on our books there's $500 of value left in that asset. Okay. Now, understand that these values, I mean, when you first buy it, in this case here, the equipment for $2,500, that was our purchase price. That's what we paid for in the store. But when you're creating these this depreciation, we use these methods. We don't go off half-cocked and creating all kind of weird numbers or whatever have you. You sit there and say, okay, I think this is worth $500 at the end of the 5 years. But you may be using that equipment 6 or 7 more years after that. It doesn't matter, all right? Because you've depreciated at $2,000. If the reason for the salvage value or the residual value is that at the end of after you've depreciated, I shouldn't say completely depreciated, after you've depreciated it, it has a certain book value. Okay, and that book value stays on your books until you dispose of that asset. Okay, so if I'm showing that the value of that equipment is $500, and let's say in year 9 I decide to trash, let's say it's equipment and it's made out of metal and it's just broken and I can't fix it anymore, okay? And I'm going to just scrap it, okay? Well, I'm not going to get any money for it, all right? If I get no money for it, then what happens is I'm able to take a $500 loss on that piece of equipment, okay? And that has tax ramifications, okay? But let's as a quick example on an automobile, okay? And we'll use my $40,000 idea on the automobile. So I have the car, I paid $40,000 for it, and I figure that my salvage value is going to be $8,000, okay? And I'm looking at that over 4 years. Right? So if my salvage value is $8,000, at the end of 4 years on my books, I'm saying it's worth $8,000. Now let's say I use that car 2 more years, and so it's now at the end of year 6, and I decide to sell that car. Okay, well, if I sell the car for $5,000, that means I'm able to show a loss of $3,000 on my books, right? Because the value was $8,000, and I'm only getting $5,000 for it, so I'm going to end up taking a loss of $3,000 on my books, which has tax ramifications. If I instead sell that car for $10,000, okay, that means I'm saying its value is 8 and I'm getting 10. That means I have a $2,000 gain on it, okay, and having that $2,000 gain, I have tax ramifications on it, okay. So that's the importance of having a residual value or a salvage value. It has to do with when you're disposing of the asset itself, okay? And again, you're at high level here, all right? You're not really going to be making all of these determinations. This is something that accountants do because they're looking to present the financial information for a business in its best light, and they also have to be forward thinking in order to be able to do that. You're here at a high introductory level, and so what the important thing here is that you understand the method and how how to use that method, how to do the numbers based upon the formula, and how to create a schedule. Okay, so that's straight line, and in the next video I'll cover units of production. Okay, and remember, if you don't understand something, pause, rewind, watch it again, and if you still don't understand, contact an instructor. Okay, I'll see you in the next video.